Hello, this is Coach Mike from winningstockcoach.com. Going to begin our market overview video for the week ahead, which will begin Monday, July 14th, 2014. Going to start out with the S&P 500. I've shrunk down the time frame. We're looking at a weekly chart, just looking at the last 2 years on the weekly. But I wanted to recap what we saw our last couple weeks and what came off of our market overview video. I make these targets based off the weekly chart. 2 weeks ago, going into the week, and actually for a few weeks before that, we had that upper high side target of 1987.68. We'd actually fallen just shy of that, but barely when we're talking about something in the range of $2,000, and we came, less than $1.50 off of it. And then last week's market overview video, I told you to watch that interim support area in 1962.11. During the week we actually dropped that, but we were able to close above it, and that's what we're really watching is our closing prices with this market overview. Now, going into the week ahead, here's basically where we are as far as I'm concerned. The 1962.11 needs to serve as our support point. I believe that if that fails, should that fail, we'll be looking at a downside to a first interim target area, 1902.53. And I had that longer term target put up of 2027.03 for the higher end. And, so long as we're buying off support, watching the S&P 500 for the 1962.11 support level to hold, that upper high side target 2027.03 is the area that I really believe 100% and honestly that we could see markets kind of top out. Now, before you get too antsy or stop playing the video, I'm going to do some more to discuss that later in the video, some comparisons on some things, so make sure you're watching and just understand, these videos aren't used at all to try to scare you out of trading or scare you out of positions you're holding. I don't believe long-term positions I don't think you should try to catch the high. I think it's so unlikely that you'll know where the high is until you're looking up at it, that you have to play them in relation to your support areas. And the more your support areas keep moving up, the happier you are with the position. So for the S&P 500, two critical levels. 1962.11's got to hold this week. Got to hold that support level. I believe if we fail that level, we head down to the 1902.50s. And if we can hold that 1962.11, our next high side target, 2027.03. Going to move over to, again, it's a 2-year weekly chart. The amount of time doesn't matter. It's that each candle represents a single week. And I want to show you, trading's been kind of weird, being in the summertime, lower volume, little awkward type movements. I want to show you here, and I'm going to outline it on my chart, that we've actually had a very easy to read series made in the markets. If you monitor, the consolidation level, we popped up, we consolidated 6 to 8 weeks, made a little pop above the consolidation. Now, I drew a line there on the consolidation high point, on the highest close, and look at what we see. We hit, we pull back from it, we hit, we close just below it, we close above it. In the 3 weeks that followed, we continued to close above, we continued to close above, continued to close above, setting a new consolidation range, and we again broke above it. Now we get into a new consolidation range, we hit, we pull back, we hit the same area, we pull back from it. Again, very, very simple technical charting tool. Run a horizontal line across it. And 2 weeks ago, we closed above, and what did we do this past week? We came down, but we still held above that consolidation line. Now, I do still have a first target area. I've been talking about it for a few weeks now with the DJI. Actually, we've had it up there for about 3 months, of $17,209.51. And we're really, really close to edging up to that area. And I have one more further longer term target of 17,906.37, which probably take a few months, may even take another pullback to get us up to that. But that's more of, if the markets continue strong and we see that the 30 stocks that make up the Dow Jones Industrial Average Composite would be two target areas we're looking for. Now, one thing that's very evident on the DJI chart, and it actually has been for several years if you go back and look at the weekly charts, but using the type of trading system which is commonly referred to as a consolidation range breakout, and it's as simple as what I demonstrated with the use of the horizontal lines and trading, and I deal with this with members of the coaches roster all the time, trying to explain to people that you're so rarely going to buy the lowest price and sell the highest price that you can't focus so much on that as you have to focus on catching the majority of a stock's run and having a proper trading system in place to give yourself the availability and reliability to continue to profit on your trades, and also to give you a little bit of comfort and patience level at times is also very important to understand. Now, as far as what we're looking at the DJI, real simple. The consolidation range break is simply playing that horizontal line that tends to form as things go sideways and waiting for the break above it. Now you can see you had prices above and below, but the closing prices remained in range with consolidation. It breaks again. At this point in time, had you entered on this break here, which was the last week of April, through May it was a little bit tedious, heart-wrenching. You get into the end of May, you get another consolidation range break. What typically happens is on that second range break, you get that nice, easy, comforting feeling in you, and it makes things a little bit easier to tolerate moving forward because you get to see the green, and you continue to move your stops up to closes within those consolidation ranges. So at this point in time, if one were trading the consolidation range breaks and simply wanting to mark one very easy thing on their chart to correlate to what their trade plan would be, and had continued playing these range breaks since the last bounce, you would find that, hey, nothing to be scared about. But if they were to stop out of the trade, meaning sell their trade because it began to break down or fail their trade plan, that if this upcoming week were to close below this horizontal line, they would simply exit their trades. And if entering before on the range breaks, that exit would actually still be for a profit. I love stopping out of trades for a profit. I'll stop out of a trade for a profit any day. Next, we're going to go over to the RUT. That's the Russell 2000. It's also referred to as the small cap index. And I've been covering for several weeks now. We had a target 12.12.63. We hit 12.13.55. Shame on me. I came $1 off, right? The point in this is we've covered over, if you go back a couple months or month and a half or so in the market overview videos, which are all public on my YouTube channel, I began to encourage down in here the research of small caps and the trade planning for small caps, because at the time they seemed to have the highest upside potential. We got right into our target, and over this past week they actually pulled back the hardest. Now the funny thing is if you correlate every one of these hard pullbacks, like if you go back to the last week of March, if you go back to the third week of January, and compare those with the S&P 500 and the Dow Jones Industrial Average, you find very, very consistent regularity to them lagging on the pullbacks by 1 to 2 weeks with the S&P 500 and 3 to 5 weeks with the Dow Jones Industrial Average. Now let's remember, the S&P 500 just hit one of our longer term targets the week before last, closed right at it, pulled back from it this past week, though only one red candle on this pullback, acknowledgeably so. Our Dow Jones Industrial Average is just shy of that same time frame target. Just shy of it, but it lags by 3 to 5 weeks. Our Russell 2000 hit our target area and made a heavy pullback from it. And coupled with that, starting this week, beginning tomorrow, the financial stocks, and it'll be several stocks, some already have reported earnings in this past week, But the financial sector is always of particular interest, really in the kickoff, the first couple weeks of the earnings season. And we're going to be seeing a lot of big name financials reporting earnings this week. Now, for example, I'm long in Wells Fargo. And their earnings this past week, they reported, they're always like the one that like to jump in first, and they weren't very impressive. Now, I held my long to see how the sector performs tomorrow with Citigroup and Goldman Sachs reporting their earnings, but I will be very quick to exit the trade up well over 25% per share. I'll be very happy to exit the trade should the financial sector not perform well early this week, as in tomorrow, with their earnings. Now, not to get too far off subject, but I just want to discuss some possibilities to help everybody with the market overview. But with the financial sector, it's been several months now that many of the experts predicted that the Fed would raise the interest rates. And people think that means the banks would be raising their interest rates. That's really not true per se. It has some effect on it, but really not true. What it is the Fed's bond buying, and the interest rates that are affiliated with borrowing from the Federal Reserve have been really next to nothing. I mean, quite literally free money for the past 5 years. Companies were borrowing money from the Fed. They are not using their on-hand cash because it's free money. That means they're borrowing less from financial institutions. Businesses still have to operate. They'll still have to have business venture loans and all of this. And a rise in the Fed's interest rates is what many believe will really help the financial stocks overall, because it'll be more encouraging for corporations and regular citizens to borrow more from the institutions rather than the government. So that's one thing that's been really important with the talk about the interest rates and whether the Fed would increase them. But I personally truly believe, and let me start out by saying the financial sector of stocks is actually my favorite to trade. It has been for years. And I fear that watching the performance and the mixed review of performance in the earnings over the last quarter and going into this quarter, it's actually played out fairly close to what I had been talking about to members of the coaches roster since November of last year. And we're starting to see some of the big name banks. 2 quarters ago, Citigroup had a big miss on earnings. Last quarter, JP Morgan, a pretty ugly miss on earnings. Bank of America last quarter beat on earnings and then comes back with this big gap down and treacherous trading since. From what? Oh, our bookstore messed up. We didn't do as good as everybody thought we did. Now we have to suspend the dividend and all this other crap that they're doing, and suspended a buyback, and it's been treacherous to the stock. Now, with all of that put together, and then honestly, one of the best set financial stocks of the national banks, Wells Fargo, not performing at all with what was expected in their earnings that they reported last week. We could actually see, with poor performance in earnings early tomorrow morning, the pullback's heightened. And that's why I wanted to kind of get off topic just slightly, but not for too long, to kind of get into that. Now, we're going to go over one more chart with the weekly, as we always do. And this is our Nasdaq Composite chart, COMP. It's not like the S&P 500, the Dow Jones, or the Russell, whereas they are, in essence, if you could kind of pretend they're like an ETF in a sense, because it's a group of stocks that the SPX, the DJI, and the RUT chart themselves kind of replicate the moves of that group of stocks. The COMP is an actual marketplace. It's the Nasdaq market, just like the New York Stock Exchange. And the movement on this chart, or the stock as some may call it, is going to be an averaged in movement of the stocks which make up the Nasdaq Composite. Now, we had talked about the breakout move a month ago on the Nasdaq, and after we got the consolidation range break, the double top that broke, and the momentum plays. Now, those worked out very, very well. If you simply watched my videos and came down here, the video that was released heading into June 16th, where we talked about the higher side potential on momentum trades for the Nasdaq, and you took that advice and followed Nasdaq charts for those couple weeks, you made a lot of money. I know I did. We talked last week that now after the move, the Nasdaq stocks need to pull back a little bit, and it would be a healthy pullback. Where would I look for them to pull back? I always look at a breakout move, a retest of the breakout point. That's my first target area. Am I shorting some Nasdaq stocks? Yes, but not very heavily. Not very heavily. But what we're seeing is, again, and sadly we've been seeing them for a year, indice charts at their highs, but starting to show some signs of weakness that could be accelerated upon based on the earnings that we see over these next couple weeks. And why I say that is, it doesn't take a lot of sense to look at this chart and say, okay, from this point to from the low to the high, there were green and red candles, meaning you had some down weeks, you had some up weeks, but the overall trend was upwards. And here we just have one red candle from last week. And where I'm getting is with the indices and the stocks up on their highs. If we begin to see that poor performance, it could trigger a sell-off on anything that were to break below any short-term trends. Now, this week's market overview video, I've been trying to keep them 10 to 15 minutes. It's going to be a little bit longer because it's very, very important for it to be longer. So those of you that don't have the patience, I apologize, but there's a lot of good work that goes into making money as an investor or trader. And if you're not willing to put that work into it, you're probably also somebody that is sitting there asking yourself constantly, why can't I make money in the stock market? Why do I always seem to lose all my trades? You have to take the time to get an understanding of what's going on and have a rational explanation for a plan of action in your upcoming trades. And that's what I try to provide for you here. So please, please, please stick with me through this longer video, because I do believe it is imperative to how you profit in the upcoming week and weeks. Now we're going to switch over to some daily charts. We've been viewing the weeklies, talking about the S&P 500, the Dow Jones Industrial Average, the Russell 2000, and the Nasdaq Composite. We're going to switch over to some daily charts. And remember, starting out here with the SPX daily, just viewing a 6-month daily so you can see the candles really well. When I was talking on the weekly chart and explaining the effect of earnings, I was still speaking of how we're sitting at a support point. And you can see it here on our chart. We had the 1987-08 high side target. We've came just shy of it. Last week's market overview video, I put an interim pullback target. We pulled back to it. Our closes all held above. And now we are facing a big earnings week. Financial sector. So let's think about what that means with the setup of our daily chart here for the S&P 500, which if you do any research on the S&P 500, you'll find it's very heavily loaded with financial stocks. Based on the earnings that we see coming out of the financial sector, if they are good, the indices have pulled back to a healthy level to make people interested in buying. Because where do you want to buy a stock? When it's pulled back to support, buying it above support, but at or close to it. Why? Because it's that effect of thinking you're getting a good price, having more confidence when a stock comes down a little bit, that now that it's come down, it can go up. And what you find many times, a lot of people tell me, all news trumps charts all the time. But what you find almost every time is, pending big events, your charts will actually set up in this way, where knowing very simple rules of trading. Where do you buy a stock to go long? A positive move from support or a break of a resistance. Where do you buy a stock to go short? A pullback from resistance or a failure of support. Heading into something like earnings, they still have to have a way to create interest in purchasing a stock if the earnings are good. And if that stock's run up and set at its highs. Sometimes you find, and people question me on this all the time, it's, how come this stock had good earnings but it pulled back? Well, because it ran up really hard into the earnings and it needed to pull back. I love to see charts pull back like this and set up into earnings, because if the earnings are good, you can find logical reason to go long. But also sitting at the support point, if the earnings are bad, knowing the 2 times you go short in a stock are a pullback from resistance or a failure of support, it doesn't have to do much to fail that support to still get you a healthy buying opportunity. And what you're seeing here is the charts set up perfectly for the news. And I don't believe news trumps charts. I believe news accelerates charts. And I love our current setup heading into the upcoming week, because charts like the S&P 500 that are heavily lopsided with the financial sector, knowing that many financial stocks are reporting earnings this upcoming week, has me confident that on good earnings I can go long, and on bad earnings I can go short, and I'm getting a good entry. Now I'm going to skip over the DJI daily chart because in all honesty it just kind of consolidated through last week. There wasn't a lot of action on it. But the Russell 2000 definitely did some boogieing. And did so in a really heavy way, not congruent with what we saw in the rest of the markets. Now, I'm a firm believer that in the harder a stock runs, the more it needs to pull back. And also, the harder a stock falls, the better probability of a bounce. Whether or not there's good or bad things going on with that stock, that's a technical anomaly that always happens. And I really believe that if you're in some small cap stocks that took a hard hit this past week, that regardless of news that might come out of the financial sector as far as earnings and whatnot, that the Russell 2000 has fallen so hard that it could get an interim little bounce. But I would use the quality of the news that you receive in this upcoming earnings week to decide if those bounces are only opportunities to allow you to exit your stock or not. If we get bad news as far as financials go from the financial sector, I still believe you could get a bounce in the Russell 2000. The small caps, they simply fell too hard. If the bad news is what's received and we get the bounce in the small caps, let's look at that as an exit potential and look for a lower high pullback to begin short entries. If the news from the financial sector is good, and I'm even talking as early as tomorrow morning with Citigroup's earnings, you actually may find more high side potential in small caps than in other stocks, simply because of how far it's fallen. And that's where I think you should kind of begin your planning and searches for the upcoming week, is on the small cap stocks that you watch. And remember, small cap, the market cap, has nothing to do with the actual price of the stock. It's an equation of the price of the stock multiplied by the number of shares, and if that equation equals a number between 300 million and $2 billion, you are in a market cap segment called the small cap. Zillow, ticker symbol Z, over $100 a share, small cap stock. Yelp, small cap stock. They're two of the largest stocks in the Russell 2000, but they're small caps. I would begin my search for planning longs in the upcoming week based on small cap stocks that have fallen the hardest, but for little reason to do so. Now, earlier in the video, I mentioned I would show you some comparisons to kind of explain some of those higher side target areas that I drew for the S&P 500, the Dow Jones Industrial Average, and how, I've said for the last few weeks, I didn't really have any higher targets than that. I mean, I never thought we'd see some of the targets that were hit, but I didn't have any targets higher than that. And, with the S&P 500, that 2027 dollars and 3 cents, I can't find another technical high above that. And I want to point to something, and we're going to talk about two things to give a little explanation on that. Now, I'm showing you a 2-year weekly chart for GLD. It's the Spider Gold Trust ETF. And what you're seeing here is that over the last year, and especially through the addition of QE3, which really came in heavy, November, December of 2012, we saw the value of gold severely decrease. Now, it had already decreased quite a bit from its all-time highs to this point due to other levels of quantitative easing, QE1, QE2, that have been around for a bit longer than QE3. But through the introduction of further quantitative easing, we saw another steep decline in gold prices. Now, one thing that is common in the history of the stock market is that precious metals tend to trend. I'm not talking about whether or not they have a one up or down day together, but they tend to trend opposite of the stocks, the stock market, the overall indices. There's a reason for that. You see, when our markets are doing well, you can usually look into the Forex markets at the US dollar and find the US dollar doing well. And one analogy I use to kind of explain things with this to make it easy with the members of the coaches roster is an ounce of gold is worth an ounce of gold in any country you go to. You can trade an ounce of gold for an ounce of gold anywhere in the world. If you're an ancient alien theorist, you could do it anywhere in the universe. But when I introduce currency, a country's currency, the value of that currency determines the monetary value of gold. Well, if you look over at US dollars charts, it's been doing very well. It's trended up to highs and just started to weaken recently. It's still floating around its highs, but you begin to see, what's called a double top, where your tops hit the same, and then all of a sudden you see a lower high, but it's still kind of hanging out in that area. And it's actually exactly the opposite of what you see here on the GLD chart. The GLD had a hard fall, made a bounce when August anticipated that we would see a September taper. September 18th come, Ben Bernanke said no taper, so we fell. December 18th came, Ben Bernanke said we're going to start that taper from QE. And we made a double bottom, meaning we held the prior support and we rose. Now, many people felt that with the succession of Ben Bernanke by Janet Yellen, we would begin to see a continuation of the taper. But over the first 4 to 6 months, her maybe stop tapering. And in that speculation, gold started to fall and consolidate again. But in recent time, now we're talking about interest rates rising. We're talking about a US dollar that's started to weaken against its peers, especially the rupee, the Indian rupee, if you look at that. And we see gold now, for literally the first time in a few years, making a higher low. Now, I've got a trend line drawn on my gold weekly chart, and we're still below that descending down channel. And one from a longer term that comes from the all-time highs. I don't have it on this chart so we can see the candles easily, but that's the line comes through that last high in 2012, And we would have a ways to go to break the overall downtrend. But this little downtrend we've been in over the last year, almost year, 11 months, could be challenged in the next week or two. This particular pattern between this ascending bottom trend line and the descending top trend line is commonly known as a wedge. Traded just like a channel, whereas you're looking for the breakout from and while trading in between a wedge because it's not parallel, it's coming to an apex point, you begin to find, yes, you're making higher lows but lower highs, and your financial gain between the two shrink each time. But this last FOMC minutes released just the other day had less speculation included on the reduction or the rise of the Fed interest rates. Last month when we saw the quarterly meeting and just kind of an overall ignoring of the interest rates, it was actually addressed. And even though they weren't raised this time, it was addressed as an important issue and something that's being seriously considered. And I believe we're going to start to see that overall decline in the markets. Now, many people have said that, and it's easy to say that. I mean, the markets are so high that any type of pullback is needed. But there's a difference in a pullback and a correction. There's a difference in a correction and a crash. And everybody wants to talk about the word bubble. And has the bubble popped? Are we in a bubble? Will the bubble pop? And I think we could start to find the difference in pullback and correction if this year-long downtrend was hit. And if this 5-year-long downtrend were hit, I think we would find the definition in the difference between correction and bubble, as they like to call it, because crash is such a bad word. And these are two technical areas on the GLD chart that I personally am monitoring quite heavily. Now, do I believe that GLD is a safe investment? I would say that if you're doing shorter term options, it's a little skeptical right now. If you're buying the common shares, oh, absolutely. I think you've got a very minimal risk. You can even follow this little trend line down here, and that would be your stop out for your long. But if you're doing longer term options, you can define your risk, trade a few strikes in the money, but still be able to define your risk. And if you're out there a year or so, I think you're perfectly fine, because what I'm seeing on the chart is a higher low. And whether it's a stock, a metal, or anything else, I'm not one that tries to catch the bottom. Why? Because people that try to catch the bottom, let me show you what people that try to catch the bottom do. They buy here and, oh crap, it wasn't the bottom. And they try it here and, oh crap, it wasn't the bottom. They try here and try here. And by the time they actually catch the bottom, they were unsuccessful so many times that it really wasn't worth trying to catch the bottom. So I let runs happen, because I know that any quality stock is not going to run and never run again. And I'll watch the time from the bottom being made to the next pullback, and whether or not that low is higher or lower. And that has a heavy determination in whether or not I decide to make a long entry in a stock. And I think we're at that point where GLD needs to be viewed as one that you may find an interest in. And if you don't want to trade the precious metal itself, I know a lot of people don't really do a lot of ETF trading, and I don't either. But I don't like mining stocks, because mining stocks kind of are part regular stock and part metal, and it makes it easier for me to just trade the metal. So the gold and silver, GLD and SLV ETFs are actually what I prefer to trade over mining stocks. And I think we're seeing a funny correlation to high long-term targets and lows, but higher lows made in the metals, all correlating here with a very, very important earnings season. Finally, I'm going to go take you over to the chart. It's the TLT. This is the iShares 20-year Treasury ETF. Now, if you do any research in the correlation between the stock market and the bond market, you actually find that they trend in opposite directions. Much like the GLD chart, the TLT, which is an ETF for the 20-year bond, has started trending in a different direction after falling hard. Very, very interesting when we look at really what I would say is how false that at least the past couple months have been in the upward trend of the stocks and the indices, because that upward trend has been met with super low volume, almost like it's all computer controlled just to hit a specific target for no reason whatsoever. Yet there's a lot of money going into the bond market right now. There's a lot of money going into metals right now. And I think we're going to see that correlation between not whether or not they make red and green candles together, but how they trend opposite to each other. I think we're going to start seeing that development in the trends. And that's something that you can't predict and say the very next day or the very next week. A trend takes time to develop. But for longer term trades, your longer term investment, things you're going to be in for a while, you might want to start to find those things with a negative beta that have been beat down in going on their longs or going on their lows, and make sure those are not things that have fallen for a reason. Gold has only fallen because our dollar has done so well and it's kind of topped out and started performing lesser than it has over the past few years. Our stock market's kind of topped out, the volume's dying out, and we're starting to see stocks that have been performing great on earnings already in the last 2 quarters not doing so well on those earnings. Is it maybe time that we see what I would just say is a much needed pullback in the markets? It's been time for that. Is it time that we maybe see the potential at a correction in the markets? It's hard to say that because I've been hoping for that for a while. But I think it will be determined based on the earnings over the next couple weeks in this quarter's earnings, very heavily this week with financials. And I think that's what you need to be watching. Now, I am sorry that this video is basically 3 or 4 times what my normal market overview video is, but I wanted to put out there some good correlations and things for you to think about and get a little more understanding of overall, so that you have a better potential at planning quality trades and profitable trades. I hope you took the time to watch the video. If not, you're not hearing me talk right now. But I wish you the best of luck in the upcoming week, and God bless.